Good day. My name is Rossouw and I'm a portfolio manager with Adviceworx Private Client Securities. I'd like to spend the next quarter of an hour talking to you about the global COVID-19 pandemic and the impact that it's having on investment markets. I'd also like to share some thoughts with you on how Adviceworx sees the way forward. This week's big international news was the conviction of former French President Nicolas Sarkozy on corruption charges. He was sentenced to 3 years imprisonment, of which he will probably end up serving 1 year. Unlike South Africa, the French have little hesitation in prosecuting former politicians. As of last night, more than 116 million people have been infected with coronavirus worldwide, and nearly 2.6 million people have succumbed to the disease. The United States remains the hardest hit, with nearly 30 million infections and over 530,000 deaths. Brazil, India, the United Kingdom, and Russia make up the top 5, and South Africa still has the 16th most recorded cases. Most countries are managing to contain the spread of the coronavirus. This week saw the number of new cases reported daily fall further in 8 of the 10 hardest hit nations, the exceptions being Brazil and Italy. America continues to make headway, but it is concerning that the state of Texas dropped all anti-COVID restrictions on Tuesday, including the mandate to wear masks. After an uptick in the daily death toll last week, fatalities in the United States are thankfully heading down once more. Sadly, Brazil's daily death toll is rising again. Vaccinations are helping to reduce mortality, and the United States has now vaccinated nearly 80 million people, China 55 million, the EU 35 million, and Britain 20 million. Globally, the number has risen to a total of 270 million. US bond yields have started to rise again despite reassurances by the Federal Reserve Chairman that inflation is not a long-term concern. Chinese manufacturers are less upbeat about the near future than their European counterparts, and purchasing managers in the services sector remain gloomy everywhere. President Biden's stimulus package is facing opposition for being too generous, and Brexit is taking its toll on the City of London. Fed Chairman Jerome Powell told the US Congress this week that any short-term rise in inflation will be short-lived and that the Fed would be able to maintain low interest rates. He reiterated his pledge that monetary policy would remain stimulatory until the economy reached full employment. Judging by the subsequent spike in bond yields, many market participants were not reassured. The so-called yield curve is a line that plots the interest yield on bonds with different maturity dates. The slope of the curve gives an idea of how the market expects interest rates to move in future. If the curve slopes steeply upwards, the market expects rising interest rates. If we compare the current US yield curve, the black line, with the curve of a year ago, the blue line, it is clear that the market expects inflation and interest rates to rise going forward. After a strong second half of 2020, business confidence in China has fallen significantly this year. Unlike in the West, the two main manufacturing purchasing managers indices were weaker than the PMI for the services sector. China is heavily reliant on exports, and February's poor PMI readings are probably indicative of concern that rising interest rates could hamper GDP growth and therefore trade. The massive rally in big technology stocks may well have run its course. There are growing signs that the market is turning to more cyclical sectors like energy, construction, and hospitality that stand to benefit from an economic recovery. Smaller companies are also outperforming the heavyweights. Oil and gold are down, and Volvo is going green. For the past 12 months and 3 years, the Nasdaq has been the world's best performing major index. For the year to date, it has been the worst, however. After a poor 2020, markets in the UK and Europe are outperforming Wall Street, with the FTSE 100 in London this week's best performer. Meanwhile, the lowly JSE Top 40 has quietly surpassed all its illustrious peers for the year to date. The price of crude oil has risen steadily in recent months. This was in response to signs that the global economy was on the mend. The poor Chinese PMI numbers, combined with fears that higher interest rates would hamper growth and trade, have caused the Brent oil price to slip over the past few days. The decline in optimism over the economic recovery has given pause to commodity prices of late. The stronger US dollar hasn't helped either. Oil and iron ore have been the best performers for the year to date, while the rise in interest rates has dragged down the gold price. Gold is regarded as a hedge against inflation and typically does best in a low interest rate environment. We remain positive about global equities, but we expect a continued rotation out of technology to more cyclical sectors. We also expect emerging markets to outperform developed markets, the East, the West, and Europe, the United States. The biggest risk to the equity market is rising bond yields. We remain skeptical about fixed income where yields are still negligible. We worry about the inflation fears that could trigger a fully fledged sell-off. We remain neutral about property, which, whilst cheaper than pure equities and yielding better than bonds, are locally. The big news this week was the relaxation of the COVID regulations when the president moved the country to lockdown level 1. Some of the key changes include the reopening of beaches, pubs and restaurants, and the lifting of the restrictions on alcohol sales hours. As of last night, more than 1.5 million South Africans have tested positive for COVID-19. The death toll is now well over 50,000, and yesterday 1,400 new infections were reported. 96 people succumbed to the disease yesterday. Gauteng still has the most cases to date with 404,000. The Eastern Cape has suffered the most deaths with 11,300 so far. KwaZulu-Natal has the most active cases with 9,500, and more than 92,000 healthcare workers have thus far been vaccinated. Public sector trade unions are outraged at the wage freeze announced in the budget, and our trade surplus shrank in January. Motorists are feeling the pinch at the pumps, and although we bought fewer new cars in February, we managed to export more. Job losses on farms and higher prices mean that we are less food secure than a year ago, but at least our dams are fuller than they were then. South Africa's trade surplus narrowed by just over 21 million rand in January. This was due to a slight drop in the value of exports, the black line, and a significant rise in imports, the green line. Most of the increase in imports was due to the higher price of fuel. Overall, the Absa Purchasing Managers Index was positive in February, but only 3 of the 4 measured categories were above 50. They were business expectations, the red line, new orders, the orange line, and output, the blue line. The outlook for employment, the green line, was less upbeat at 44 and reflects South Africa's structural unemployment crisis. Thanks to this summer's excellent rainfall, our country's dams are mostly fuller than this time last year. The notable exceptions are the Western Cape, which is approaching the end of its dry season, and the Eastern Cape, which is battling an extended drought. Dams in the Orange and Vaal River systems are overflowing, and the 3 northeastern provinces are still getting more rain. The JSE is riding high in global rankings, both in rand and dollar terms. Resource shares played a prominent role in this regard. The bond market has run out of steam since the budget, as has the rand. Standard Bank suffered a major drop in headline earnings last year, and the lockdown has hit rentals in Canal Walk Mall. Pension funds may soon be able to invest more into alternative assets. Foreigners were net sellers of both bonds and equities last week, with the JSE losing nearly 7 billion rand and the bond exchange almost 14 billion rand. For the year to date, the JSE has suffered outflows worth just under 6 billion rand, but the figure for the bond exchange is still a positive 10.4 billion rand. After standing its ground against the US dollar for nearly a year, the rand weakened against the resurgent greenback this week. We are not alone, however. Most emerging market currencies lost ground as higher bond yields attracted portfolio flows into the US market. Along with citrus fruit, avocados have been the stars among our agricultural exports. Avo farmers have been producing steadily more of the fruit in recent decades, and it is estimated that production for the 2020-21 season will be at least 30% more than 10 years ago. In Africa, only Kenya produces more avocados than South Africa. Mexico is the world's leading producer. Locally, the equity market has been strong so far this year, but valuations are still fair and prospects for earnings growth look promising. Real bond yields remain attractive, but we remain mindful of risks to the fiscal outlook going forward. We continue to avoid listed property and regard cash merely as a liquidity tool because of the low interest rate it offers. The Adviceworx PCS asset allocation view can be summarized as follows. Because of the economy and the weak rand, we remain overweight global equity and underweight South African equity. We remain neutral on global property where valuations are reasonable, but negative on South African property. We hold no global fixed income, and we remain overweight South African bonds. Thank you very much for your time and attention. We certainly live in interesting times, and I hope that this presentation will help you make sense of them. Should you have any questions or queries, please don't hesitate to contact me or your Adviceworx financial advisor. I hope you'll have a lovely day and a splendid weekend. Until next week, goodbye from me.